of Bank of America Merrill Lynch joins us on the phone line from New York. And in a bit, Sameer Arora, founder and fund manager at Helios Capital, is also with us. Ethan, first, good morning to you. Okay, Sameer is also with us. Good morning to both of you, gentlemen. Ethan, first up, how should an emerging market investor read the Fed's cues? In the morning today, Asian markets and the emerging markets are marginally higher. It's not a runaway rally. Should we expect that we are not going to see a return of funds to EM markets?
Well, I think that the message from the Fed move today is a positive one in the sense that, I think global markets have been waiting a long time to see the Fed move, and there have been a lot of concern when the Fed delayed their rate hikes because there's a sense that the Fed had so little confidence in the U.S. economy, it was unwilling to move. So I think that now that the Fed has hiked, and they've also sent a message of gradualism, that they're going to go very carefully here, and the way to view this is kind of a vote of confidence in the U.S. economy. And so from the point of view of global markets, I think there's a big difference between the Fed hiking interest rates in a big battle against inflation, which is very bad for risk assets in global markets, but a Fed that's raising rates because the U.S. economy is healthier is something I think the markets can handle.
Okay, so there is a vote of confidence in the U.S. economy, but let's get Sameer Arora of Helios Capital into this discussion as well. Sameer, hi, good morning. Does that perversely work against emerging markets like India? Because now that developed markets like the U.S. are doing better, do you see money move into developed markets versus emerging markets in the first half of 2016?
No, not at all. In fact, I'm a very simple guy. So I just remember what happened last time when the US rates were hiked. US rate, Fed Reserve raised hikes 17 times in 2 years and a few months between 2004 and 2006. Do you remember what happened in India and other markets at that time? So, this first quarter percent hike suddenly making people move from emerging markets to developed markets as if we did not know that the US economy was doing at least this well. They have not said it's doing very well, they are doing it's okay, which broadly the whole world knew. And the US market anyway has been doing very well and deserves to do well. But I don't think this makes people move from emerging to developed markets. As I said, 17 hikes didn't change it when things turned in any individual market or as a group in emerging markets. So I don't think this is matter.
Okay. Well, Sameer, there are still two things that could go against EM basket, and chances of India getting bracketed in that basket remain. So, Ethan, on that note, there are still problems of commodity prices not being able to improve at all. Crude actually inching lower and now, even below their 2008 levels on a few days and a few hours. As well, basically, when it's a rate hike syndrome, you could see some bit of money moving away from emerging market bonds. Equally, for both reasons, how should an emerging market equity investor interpret the next 2 months in terms of fund flows?
Well, I think that there certainly are risks. I mean, when the Fed is hiking, it attracts money into the U.S. I think for commodity producers, this has been a terrible market, and investors really are very concerned about the continued drop in oil prices. But, again, I don't think of this as, a kind of really a bad environment in the sense that, this is not going to be like the taper tantrum of 2013 when the markets are completely surprised by the Fed saying that they were going to start ending their bond buying program. This is more something that we've had a long time to prepare for. It's been well telegraphed by the Fed, and so I think it's it's a little easier to absorb. But yeah, I mean the general weakness in growth in emerging markets, the fact that many of these economies are sensitive to the commodity markets, that is going to be an ongoing problem. I don't think the Fed is the problem. I do think weak commodity prices is a problem.
Okay, Sameer, I take your point that last time when the Fed hiked rates, we actually had one of our biggest bull markets. But this time, do you think things are a bit different? For our markets, there are domestic problems which have been well documented. There's a perception building up that not much has changed between, say, UPA 2 and NDA. You've seen not much progress in GST, Parliament logjam. Do you think that will continue to be a bigger trigger for the market in terms of capping the gains?
That has already happened, and I don't think that will happen anymore. As you said yourself, it is well documented. If it is said that this government had announced last week that we are privatizing the airports in India, how would you have reacted to that? The poor guys can't even announce to you what they have done. Effectively, they've handed or privatized Ahmedabad and Jaipur airports and given them to Changi. But because of the environment in which we operate, we can't even come out and say things. The government cannot even come out and say that how they have cut subsidy, where is the food bill. They can't say all these things, all the things which we took as negative when they were announced by the UPA government, that these are very bad, these will blow out fiscal budget. But when this government has actually, in a sense, basically reversed all those things, they can't openly come and tell you. But the markets are not going to work just because somebody says it or not. They can see that there are massive changes in this government. Also, many things that we said a few months ago that what the government has done has not come or reflected into somebody's, not necessarily a corporate's bottom line, but into some change on the ground. I think that is happening in nearly every sector. For example, when this state SEB restructuring happened, even I thought that it would take months and years for some states to agree, and I met some government guys who said maybe Rajasthan will be the first one and it takes 6 months. It's like some 10, 12 have already agreed. Similarly, when this insurance FDI increase was happening, I was criticizing, saying 6 months have passed and nobody has been given approval. Suddenly 5-7 guys have already got approval and maybe the transaction is already over. In every sphere, now you can see change. The only reason why people are still crying is because those corporates are still crying. For how many years did we say that diesel vehicles should be taxed? Not in those days because of pollution, but because diesel used to be subsidized. Now, obviously the auto lobby fought and said no, no, no. And for 5 years, I think for 5 years, I would have been saying it on CNBC 3-4 years ago. Not at that time thinking of pollution, but thinking of the fact that diesel is subsidized. Now, if somebody gets banned, if something happens, obviously, guys, tomorrow you'll see some negative noise from India. But the overall change is significant, and I think markets are.
So Samir, for a viewer who's watching you right now, and with this Fed uncertainty out of the way, what would you advise him to do?
No, before that, let's go to saying that the US, let's do more on the US Fed just because it's a US Fed related day. Then, people say that there'll be a 1% hike, let's say over a year, as they expect on this thing over 4 quarters, say 25 basis point a year. So what will people do in US bonds first, tell me? The current US 10-year is giving you 2%, 2.3%. So if they think that after 1 year, your bank rate will be 1.5%, who will buy US bonds? So should people move from US bonds to US equities and US bonds to emerging markets? Or should they worry about India because in some other country oil is falling? India is today, I think, in a great place because finally there are going to be changes on the ground, and where there are no changes, those guys deserve to have no changes in their life.
No, I take your point entirely that Indian macros have improved and the government can take a lot of credit for that. But let me just wind up this conversation with Ethan on what is his expectation of 2016 rate hikes. What's your trajectory, Ethan?
Well, I think that the Fed's going to go very cautiously here. I mean, they're in no rush. Inflation's low in the U.S., and it's not going to rise very fast. And so, the last thing they want to do is undercut the recovery. They're only going to hike as much as the economy and markets can handle. Our view is that they'll probably end up doing 3 or 4 hikes. So that would be either every other meeting or maybe every third meeting. And that would be, and they would hesitate if they saw some real pain being imposed out there. Now, for the global markets, it should be reassuring that the Fed will not push harder than it can be handled. But the Fed's mainly focused on domestic markets. So if we were to get some difficulties in emerging markets, I'm not sure that would be the kind of thing that would slow the Fed down. But again, if the U.S. economy or markets are under pressure, they could go, they could skip a few meetings at a time. So it's going to be slow, 3 or 4 hikes next year.
Okay, so 3 or 4 hikes next year. I'm sure you heard our other speaker, Sameer, talking about the improvement in the macros in the Indian markets. Ethan, do you track India, and what would your view be now?
Well, I'm not the specialist in India, but it's one of the emerging market economies we're more optimistic about. That's what I would say.
Oh, right. Ethan, thanks a lot for joining us this morning. Sameer, we need some more answers from you. Basically, we have not seen the earnings trajectory tick up. That's really everyone's grouse. Do you see that improving? I assume that any extraordinary growth in Indian indices will be contingent on earnings improving.
Madam, just sit back and relax, and it will automatically happen because of a thing called base effect. Let's look at big picture. Exports have been down 12 months in a row, and I think it was 1 year ago exactly this month or the previous month that there was the last increase of 7% or something like that. Now tell me, if you just do at this pace when you've been falling 15-20% on exports, suddenly it'll happen that you will be now comparing yourself with a year or a month 1 year ago, which itself was down a lot, and suddenly it looked big improvement. The same thing is going to happen in India across sectors. If for 2 years we've had a drought and now there's a slight rain, hopefully, suddenly on year on that will look okay, or people will look beyond it. But on other sectors, if you look at our denominator, currently 40% of earnings may be coming through commodity sector, export-oriented sectors, or these material, metal-type companies, which have their earnings have fallen 80-90%, or maybe they made losses.
Yep.
Their life does not have to change as long as they don't make massively more losses next year, and suddenly their negative impact on the aggregate earnings will change. So just relax, because this is what is called a cycle. That is why actually you don't need governments every day, every morning, every policy, every GST. There's a cycle, and that cycle has turned in India's favor. It got hurt this year because of actually a benefit to India of oil, but obviously that impacts our own and oil and stroke commodities, because it also affects aggregate earnings of our market. But all those things are getting sorted out. We would have, let us say next year also $40 oil, and this year is 40.
Yep.
This year has gone from 100 to 40, and therefore on earnings it looks very bad of that group of companies which are not necessarily directly oil, but let's say oil stroke commodities. Next year 40 to 40, no change in that group, and still it's a very good price to have, and you are set.
Okay.
So you don't need anything, you just need to hang around like this,
Okay.
and suddenly the denominator will be more bearable.
Okay. Sameer, the other problem for this market has been that despite so much domestic liquidity, the market hasn't moved at all, at least at the index level. Do you see that changing in maybe 2016?
This year people say that FIs have given up, why they are not coming into India. Actually, they've invested, some 3 billion or something like that, which used to be around 15-20 billion before. But this year, the net that redemptions that they would have done from emerging markets would be the order of 50-60 billion.
Yep.
Plus, so we have got positive and the whole emerging group is negative. Secondly, we have got record high, I believe, or very high, flows into private equity and directly into e-commerce ventures, which at some conceptual level is coming from the same group of investors, maybe a different arm of the same government, sovereign fund, or private high net worth individuals, family offices. Ultimately, it's the same money going into the same market, and therefore, actually, India, we have not lost any real interest, particularly when compared with the backdrop of that the rest of the group had massive redemptions, and they did not have matching private equity and e-commerce flow. So India, there is a lot of interest, and India is doing okay, and with a few more, I also believe, by the way, that when the government lost Bihar elections, suddenly you saw a lot of activity on things which may have been already in the pipeline, but they sort of put them out there. And now that the GST is basically gone, which, by the way, if you had heard my interview, which on your channel or whatever, on your program, it was anyway not going to be happening this year. He had sort of already agreed that even if it was to be passed in this parliament, the earliest would have happened would have been October, which also I think is unlikely. It would have anyway happened in April 2017. Now, since nobody understands my questions or the answers, and suddenly the GST is delayed. Its end implementation, I don't think, is still delayed. But even if it is out of the way, is it not logical to believe that between now and Feb, when the budget is, or in the budget, you shall be throwing out every day more and more things that are in the government's control? It is sort of too obvious according to me, but let's see.
Yes, of course. We just heard even yesterday commercial mining being allowed for state-owned enterprises. So that perhaps is the first step, and it'll be a short step now to allow private companies commercial mining. That is definitely a very big change from the nationalization of coal days. But Samir, at the moment, how long or short are you? And in the last 2 weeks in December, where have you gone short?
No, short, we have reduced. Currently, we are 75 net. We are 110 long and 35 short.
Okay.
Okay.
And incrementally, where may you be long or short? I'm only asking sectors.
Even yesterday for today's event,
Yep.
we even got after a long time Bank Nifty. Basically, we think we want to be bullish for quite some time now.
Okay, Samir, before we let you go, I just wanted to take Anuja's point forward, the point he made about the domestic institutional investors. The last time we saw really big inflows from domestic institutions, that was way back in 2008, where we got almost 75,000 crores of inflows in 1 year. And since then, we saw what happened to the markets. There was a big fall post that 2008 debacle. I'm not saying that history is the best judge of these things, but do you see the possibility of such an event recurring again?
First of all, last time, it's not that the market fell because the poor Indian guys put money in the fund. It happened for independent reasons. But the difference is that here also we have not come early into the game because the market has broadly in rupee terms been quite okay. But this year they are down on average maybe 2-3% because the market in rupee terms is down 5%, and if they've averaged through the year they are down 2%. So big deal. This is a patience game in that sense. But to think that the market will fall 30-40%, or actually that time it fell 50%, would mean a global crisis. So today, on what basis should we assume a global crisis? I'm not assuming right now. If it happens, anyway, you can call me and we will do another interview.
We'll definitely do that. You'll always be there, whether global crisis or not.
Global crisis, I hope it never happens again in my next whatever 20 years that I'm going to do this.
No, you'll be our knight in shining armor if in case a global crisis
In
happens.
any case, Samir, you've given, I think, the Indian markets your own way of a Christmas gift by saying that you actually turned long on Bank Nifty lately.
But that is more of an event. Bank Nifty is just to play an event. So even if we cover it over time, we would still go into the year end with our final year end of at least 71-72%, or maybe we'll substitute with something else. But right now, I think that our stars are aligned, and this year actually we have done quite well. So we are willing to risk a little bit more than usual.
Okay, congratulations for that, for a great 2015, and for that bullish note for 2016 as well. Samir Arora, pleasure speaking with you as always. Thank you so much for joining us.